Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What you're doing right here is you're selling obligations. You're selling an obligation at 120. You're saying that I'm willing to buy the underlying at 120, and I'm willing to sell the underlying at 127. If it's in between there, your obligations have been met, meaning that at expiration, if it's between those two, that you don't necessarily have to worry, so to speak, about losing money on it once it's actually at that area. So the condor, you can see it's giving you about a 50% profit, but you have a wider range of error when doing so. Now, the other thing that I want to mention when you're doing a strategy like this, don't expect that all the time. You're going to be wrong at times when you're doing this. So with that being said, don't expect to make 50% every month. If that were the case, then someone would have solved the national debt by now. So just understand that, yeah, you can make 50% a month doing this, but you can lose 100% a month doing this also. Okay, a couple of questions that we have. One from Andrew. How did you choose the condor short strikes? Well, in this example, I just made them up. One thing that I would say, Andrew, when we're talking about making a trading plan and how frequently you want to be right, how frequently you want to be wrong, if you can stomach being wrong a lot, then narrow up the strikes. You'll make more money that way. But if you need to be right more often, if you can stomach being wrong a lot, narrow the strikes. You'll make more money. But if you need to be right, then widen them out a little bit. Just understand that when they're wide and you're wrong, it's gonna bite you in the butt. So just have that mentality when you're doing this. Okay, then we have another question from Bruce. You can pick your short strikes outside of monthly support and resistance pivot levels and the underlying support and resistance levels. Would that provide reasonable safety? Well, it could. If you're a believer in technical analysis, the bottom line is this. What do you think the stock's going to do? Or in this case, what do you think the currency is going to do? And if you don't think it's going to go above or below support or resistance, then by all means, that would work well. Okay, from Steve, how do you optimize for commissions? Well, at OptionsXpress, we only charge you on it's considered one trade, so we don't charge you for each leg of the trade. It's either $1.50 a contract or $14.95, whichever is greater. So with that being said, if you're doing a one-lot condor, meaning a 1 by 1 by 1 by 1, that would be $15. If you're doing 100 by 100 by 100 by 100, then it's going to be a lot more than that, $1.50 a contract. Now, there's some other reasons for being non-directional. Of the 6 factors of option pricing, implied volatility is often overlooked. I'm going to quote Alex Jacobson from the ISE, and this is one of my favorite quotes that Alex does very frequently when he speaks. And by the way, if you ever want to hear a great speaker, if you ever get a chance to hear Alex Jacobson on any webinars or in any in-person events, I'd highly recommend going to watch him. But with this, you can be right on the trend of the stock or the currency and wrong on volatility and still lose money. But you can also be right on volatility, but wrong on the trend, and still make money. Now, is that always the case? No, but that can be the case. A couple of things that I want to leave you with before we open it up for questions. If you believe that implied volatility is high, you might want to consider selling implied volatility, or being short implied volatility by selling currency options. Now, let's take a look at the loonie on the OptionsXpress website. Let's go ahead and check that out real quick. And I want to show you a way with which you can look at volatility. Now, volatility is high only if you think it's high. Volatility is low only if you think it's low. What does that mean? Well, some people believe that bank stocks are very high or are very low right now, and some people believe that they're still high. So by looking at this, how do you tell whether this is high or whether this is low? Well, it's just like anything else. Right here, let's say just past October, people were believing that volatility was high. The volatility number is based on the right side. So with that, if you were trying to short volatility, then you might have been right. It was high historically. However, the market didn't think you were right. Volatility went up another 50%. So with that, you would have been wrong. Now, you can use a lot of things for volatility. You can use fundamental analysis, technical analysis, but the bottom line is this. If volatility goes down, then the value of an option will go down, assuming all other factors remain constant. So respect volatility when you're making a trade. Now let's talk about time decay. No matter what, time decay works in favor of the option seller. Doesn't matter where the underlying is at expiration. If your short options are out of the money, you're going to make money. Now, if you're too bullish to try doing some type of a time decay strategy on the stock market, you don't want to do a covered call or something like that, you might want to consider another investment vehicle, such as the currencies. Let's say that you're too bullish or too bearish on the currency or on the stock market right now, but you still like the idea of doing a condor or a butterfly or something along those lines. Well, there's no law that says that you have to trade in the stock market. A question that I always pose to people is, if you're ever at a party and you said, I just made millions of dollars trading currency options, do you really think that you would get laughed at and say, oh, you idiot, if you were smart, you would have done it in the stock market? I doubt that would be the response that you get. Now, am I trying to say that you're going to make millions of dollars doing this? No. I hope you do, but I'm not trying to say this. The point is this. Open your mind. This is a great product to consider. Now, the other thing that you can do with this is hedge. Oftentimes, in a longer-term portfolio, people may buy foreign bonds just to get some type of currency exposure. Let's say you want to buy a bond over in Europe to get some exposure to the euro. Options might offer a more efficient way. Now, let's say that you're buying a bond on some government that's in the European Union that follows the euro. If you don't feel comfortable going overseas, one thing that you could do, let's say you were going to invest $10,000 in that European bond, you could consider perhaps buying a bank CD, and with the interest that's paid on the bank CD, you could put in $500 into the euro. Now, that would be a European option. That would be an option on the euro itself. So that way, the money that's taken in from the CD finances the purchase of that call option. Now, does that work every time? No. Sometimes it does, sometimes it doesn't. With interest rates low right now, it may not work as easily as it has in years past, but it's something to consider. Now, before we open it up for questions, just want to mention currencies offer you a way to be market neutral no matter what your stock market bias. I promise you, if you make millions of dollars trading currency options, no one will make fun of you at a party for not doing it, for not being able to get it done in the stock market. They can be traded in any option brokerage account, including an IRA. Now, a webinar that I did with the ISC a couple months ago was talking about the correlation of currencies to U.S. stocks. And Steve Meisinger actually wrote an article on that. And this could be an efficient way to where, because of the lack of correlation that typically exists, now it's not always the case, but it's not like there's more correlation usually with bonds and the stock market as opposed to currencies in the stock market. Now, correlations can and do exist at times, but over time, Steve and I have spent a lot of time on it, and we have not been able to find a true correlation of currencies in the stock market. So if you want to come at this with kind of a neutral bias, this could be a product with which you can look at.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.